In a federal courtroom in Orlando, Florida, an empty chair sat where defendant Sholam Weiss should have been, the man who orchestrated what investigators would later call one of the largest insurance frauds in American history had vanished, jumping bail just weeks before his conviction. What the jury didn't know as they delivered their guilty verdict was that this case would expose a web of financial manipulation so sophisticated, so audacious, that it would cost 25,000 policyholders their life, savings, and reshape how America regulates its insurance industry forever. The National Heritage Life Insurance Company had been a trusted name for decades, holding policies worth hundreds of millions of dollars. Families across America paid their premiums faithfully, believing their futures were secure. They had no idea that a small group of men had purchased their insurance company with money that didn't exist, using a scheme so brazen it defied belief. Before we dive into this shocking story of greed, deception, and institutional betrayal, make sure you're subscribed to our channel. We investigate these forgotten financial crimes that shaped modern America, uncovering the truth behind cases that authorities tried to bury. This isn't just about insurance fraud, it's about how criminals learn to exploit the very systems designed to protect us. Today, we'll explore how a rabbi, a strip club owner, and a network of businessmen pulled off the greatest insurance heist in American history, and why similar schemes continue to threaten your financial security today. Narrator. To understand how criminals could steal nearly $500 million from an insurance company, we must first understand how that company came to hold such enormous power over American families' financial futures. The decades following World War II saw an unprecedented expansion of the American insurance industry. Returning veterans, flush with GI Bill benefits and steady employment, sought to protect their growing families with life insurance policies. Companies like National Heritage Life Insurance, founded in 1960 and headquartered in Orlando, Florida, built their reputations on promises of financial security that would last generations. By the 1980s, National Heritage had grown into a major player in the life insurance market, managing hundreds of millions in policyholder funds. The company specialized in whole life and annuity products, attracting customers with competitive rates and aggressive marketing campaigns throughout the Southeast. According to Securities and Exchange Commission filings, National Heritage Life reported steady growth throughout the 1970s and early 1980s. The company maintained offices in multiple states, employed hundreds of agents, and held assets exceeding $300 million by 1985. Policyholders trusted the company with their most important financial decisions, money for their children's education, retirement funds, and death benefits that would support their families. But beneath the surface of corporate success, National Heritage was experiencing the same pressures that affected many insurance companies during the late 1980s. Economic recession, increased competition, and poor investment decisions had begun to strain the company's finances. Corporate records reveal that by 1989, National Heritage had suffered a devastating 34% decline in revenues. The company reported significant operating losses for the first time in its history. Industry analysts noted that National Heritage, like many mid-sized insurers, was struggling to compete with larger companies that could offer better rates and more diverse products. In 1990, state insurance regulators in Delaware, where National Heritage was incorporated, delivered an ultimatum that would seal the company's fate. The Delaware Insurance Department threatened to shut down National Heritage unless the company could raise additional capital immediately. This regulatory pressure created a crisis that would attract the attention of opportunistic criminals who saw vulnerability where others saw risk. What happened next would demonstrate how financial desperation could make even established institutions susceptible to the most brazen forms of fraud. The stage was set for one of the most audacious financial crimes in American history, perpetrated by men who understood that a struggling insurance company was not just a business opportunity, it was the perfect vehicle for theft on an unprecedented scale. Narrator. At the center of this financial conspiracy stood a man whose background seemed to embody the American dream gone wrong. Sholam Weiss, a 40-year-old rabbi from Monsey, New York, had built a reputation in Orthodox Jewish communities as a successful businessman and religious leader. Court documents describe Weiss as charismatic and persuasive, a man who could move seamlessly between the world of religious scholarship and high-stakes business deals. Friends and associates later testified that Weiss possessed an unusual combination of religious authority and financial acumen, qualities that would prove essential to his criminal enterprise. FBI investigation files reveal that by 1990, Weiss had already established himself in several legitimate business ventures throughout the New York metropolitan area. He owned real estate, invested in various companies, and maintained the lifestyle of a successful entrepreneur. But according to federal prosecutors, Weiss harbored ambitions that far exceeded his legitimate income. The opportunity that would transform Weiss from a small-time businessman into the architect of massive fraud came through an unlikely connection. Investigation records show that Weiss had formed a relationship with several individuals involved in New York's entertainment industry, including strip club operators and nightclub owners. Among these connections was a man named Ludwig Feinberg, who federal investigators later described as a key facilitator in Weiss's criminal network. Court testimony indicates that through Feinberg and others, Weiss learned about the financial vulnerabilities of companies like National Heritage Life Insurance. According to testimony provided during the federal trial, Weiss recognized that a struggling insurance company represented an extraordinary criminal opportunity. Unlike banks, which faced heavy federal oversight, insurance companies in the early 1990s operated under state regulation that was often less sophisticated and more easily circumvented. Prosecution evidence suggests that Weiss spent months studying National Heritage's financial condition, reviewing public filings, and identifying the specific weaknesses that would allow him to gain control of the company. Court records indicate that he was particularly interested in the company's large cash reserves, money that belonged to policyholders but could potentially be diverted if someone gained control of the corporate structure. The plan that emerged from these calculations was breathtaking in its simplicity and devastating in its consequences. Rather than robbing National Heritage Life Insurance, Weiss and his associates would buy it using money that didn't exist. Federal prosecutors later described the scheme as a sophisticated variation on check kiting, a classic financial fraud technique adapted for the insurance industry. The plan required precise timing, fraudulent documentation, and the cooperation of multiple conspirators who could maintain the illusion of legitimacy while systematically looting the company's assets. What investigators would later discover was that Weiss had not conceived this plan alone. Court evidence revealed that he was working with a network of co-conspirators, each bringing specific expertise that would be essential to the fraud's success. These included individuals with experience in corporate finance, insurance operations, and money laundering. The conspiracy was about to purchase one of America's major insurance companies with a check they could not honor, then use the company's own money to make the purchase appear legitimate. It was a plan that would take years to fully execute and would ultimately destroy the financial security of thousands of American families. On a spring morning in 1990, National Heritage Life Insurance Company received what appeared to be a salvation offer. A group of investors led by Sholam Weiss presented a proposal to purchase the struggling company for $4 million, exactly the amount of capital the Delaware Insurance Department demanded to keep National Heritage operational. Court evidence later revealed the audacious nature of this transaction. The buyers presented a cashier's check for $4 million to complete the purchase, but according to FBI financial investigators, the purchasers did not actually possess $4 million. Instead, they had written a check against funds that existed only on paper. Federal prosecutors described the technique as a sophisticated check-kiting operation adapted for corporate acquisition. Traditional check-kiting involves writing checks between accounts without sufficient funds, creating the temporary appearance of money that doesn't exist. Weiss and his co-conspirators elevated this basic fraud to unprecedented levels. The scheme worked because of precise timing and the complexities of corporate banking. Investigation. Records show that after gaining control of national heritage, the new owners immediately began lending company money to themselves, creating the funds necessary to cover their original $4 million purchase check. Financial analyst testimony presented during the trial explained how this was possible. As owners of National Heritage, Weiss and his partners could authorize the company to make loans to various entities they controlled. These loans, totaling millions of dollars, were then used to create the appearance that the original purchase had been legitimate. The sophistication of the operation became clear as investigators traced the money flow. Court. Documents reveal that within weeks of the takeover, National Heritage had authorized loans totaling more than $10 million to various companies and individuals connected to Weiss. These loans were rarely documented properly and were never intended to be repaid. Meanwhile, state insurance regulators, satisfied that National Heritage had been recapitalized, allowed the company to continue operations. The new owners maintained the appearance of legitimate business, continuing to sell policies, collect premiums, and pay claims. Policyholders had no indication that their insurance company had been purchased with fraudulent funds. Records from the Florida Department of Financial Services indicate that during the early 1990s, National Heritage continued to appear financially stable to outside observers. The company maintained its state licenses, passed routine examinations, and even expanded operations into new markets. But according to federal investigators, this appearance of stability masked systematic looting that began almost immediately after the takeover. Court evidence shows that Weiss and his co-conspirators were not interested in running an insurance company. They wanted access to the vast sums of money that policyholders had entrusted to National Heritage over decades. The method of theft was both sophisticated and brazen. Prosecution evidence revealed that the conspirators used a variety of techniques to extract money from National Heritage without triggering immediate regulatory attention. These included excessive management fees paid to companies controlled by Weiss and his associates. Court documents show that National Heritage paid millions in consulting fees and management costs to entities that provided no legitimate services to the insurance company. Fraudulent reinsurance contracts that transferred National Heritage's reserves to companies that existed only to receive and launder the stolen money. Insurance industry experts testified that these contracts served no legitimate business purpose and were designed solely to move policyholder funds beyond the reach of regulators. Document evidence, fake contracts, shell company formations, offshore accounts, suspicious investment transactions that involved purchasing assets at inflated prices from companies controlled by the conspirators. Federal financial analysts determined that National Heritage paid far more than market value for various investments, with the excess payments flowing directly to the fraudsters. The genius of the scheme was that each individual transaction appeared potentially legitimate to regulators conducting routine examinations. The pattern only became clear when investigators later assembled the complete picture of money movement over several years. By 1993, according to court testimony, National Heritage Life Insurance had been transformed from a legitimate insurance company into a sophisticated money laundering operation. Policyholders continued to make premium payments, unaware that their money was being systematically stolen by the company's owners. The theft continued for nearly 4 years, during which time investigators estimate that Weiss and his co-conspirators extracted more than $400 million from National Heritage. This money belonged to thousands of families who had trusted the company with their financial futures, believing their policies would provide security for their children and retirement funds for their old age. Behind the staggering financial figures of the National Heritage fraud lay thousands of individual tragedies. Families who had faithfully paid premiums for years discovered that their policies were worthless. Retirees found that their annuities would never pay out. Parents learned that the college funds they had built for their children had vanished. Insurance Department records reveal that at the time of National Heritage's collapse in 1994, the company held approximately 25,000 active policies. These represented families from across the Southeast who had entrusted National Heritage with some of their most important financial decisions. Court victim impact statements paint a devastating picture of the fraud's human cost. Margaret Thompson of Jacksonville, Florida, had purchased a $50,000 whole life policy from National Heritage in 1985 to ensure her children would have money for college. She paid premiums faithfully for 9 years, believing she was building a secure future for her family. When National Heritage collapsed, investigation records show that Thompson discovered her policy was essentially worthless. The money she had paid over nearly a decade, more than $8,000 in premiums, had been stolen by Weiss and his co-conspirators. Her children's college fund existed only on paper. Thompson's story was repeated thousands of times across the Southeast. Federal investigators documented similar cases involving retirees who had purchased annuities expecting steady income during their golden years, young parents who had bought term life insurance to protect their growing families, and small business owners who had used National Heritage policies as collateral for loans. Court records include heartbreaking accounts from victims who described the devastating impact of discovering their insurance company had been a fraud. Robert Chen of Orlando had purchased a $100,000 life insurance policy from National Heritage in 1990, the same year Weiss and his associates took control of the company. Chen, a small restaurant owner, paid premiums for 4 years, believing he was protecting his wife and 2 young children. When National Heritage was liquidated in 1994, Chen learned that his policy would not pay out. The premiums he had sacrificed to pay, money taken from his family's grocery budget and his children's clothing allowance, had enriched criminals instead of securing his family's future. The scope of the victimization became clear as state insurance commissioners attempted to determine the extent of National Heritage's obligations to policyholders. Records from the Florida Office of Insurance Regulation show that the company's legitimate liabilities exceeded $300 million at the time of collapse. This meant that even if investigators had recovered every dollar stolen by Weiss and his associates, there would not have been enough money to pay all policyholder claims. The fraudsters had not only stolen from National Heritage, they had deliberately driven the company into insolvency, ensuring that legitimate claims could never be paid. Insurance industry experts testified that National Heritage's collapse represented one of the most complete destructions of policyholder value in American insurance history. Unlike bank failures where federal deposit insurance protects most customers, insurance company failures in the 1990s offered limited protection to policyholders. State guarantee associations, which provide some protection when insurance companies fail, were overwhelmed by the magnitude of National Heritage's collapse. Court documents reveal that guarantee fund payments covered only a fraction of policyholder losses, leaving thousands of families with little recourse. The psychological impact on victims extended far beyond financial losses. Investigation records include statements from policyholders who described losing faith in the entire insurance industry. Many had purchased National Heritage policies based on recommendations from trusted agents, and the company's collapse shattered their confidence in financial institutions generally. Dr. Sarah Mitchell, a psychologist who counseled several National Heritage victims, later testified about the emotional trauma experienced by fraud victims. Her clinical notes, presented as evidence in related civil litigation, described patients experiencing symptoms similar to those seen in other betrayal trauma cases. Victims reported feelings of shame and self-blame, wondering whether they should have recognized warning signs about National Heritage's stability. Many experienced sleep disorders, anxiety, and depression related to their financial losses and concerns about their family's security. The ripple effects extended to victims' families and communities. Children who had been counting on insurance money for college were forced to abandon educational plans. Elderly victims who had expected annuity payments were compelled to return to work or depend on relatives for support. Economic analysis conducted years after the fraud revealed that National Heritage's collapse had broader community impacts. Small businesses that had used insurance policies as loan collateral faced foreclosure when those policies proved worthless. Local economies in areas with high concentration of national heritage policyholders experienced measurable negative effects. The human cost of the national heritage fraud extended far beyond the $450 million in stolen money. It represented a betrayal of trust that affected thousands of families and demonstrated how white-collar crime could destroy lives as completely as any violent offense. For the victims, the collapse of national heritage life insurance was not a complex financial crime. It was the theft of their children's futures, their retirement security, and their faith in the American financial system. The first signs that something was wrong at National Heritage Life Insurance Company came not from government regulators, but from the company's own employees. By late 1993, according to court testimony, several National Heritage staff members had begun noticing irregularities in the company's operations that suggested serious financial problems. Mary Rodriguez, a senior accountant at National Heritage, later testified that she had become concerned about unusual loan transactions that seemed to have no legitimate business purpose. Her internal reports, presented as evidence during the federal trial, documented millions of dollars in payments to companies she could not identify in any standard business directory. Rodriguez's concerns were echoed by other employees who noticed that National Heritage's cash reserves appeared to be declining rapidly despite continued premium collections. Court records show that several staff members had approached supervisors with questions about these transactions, only to be told that the company's new ownership was implementing sophisticated investment strategies. The investigation that would ultimately expose the fraud began in early 1994, when the Florida Department of Financial Services received anonymous tips about potential irregularities at National Heritage. State insurance examiner James Patterson was assigned to conduct a routine financial audit of the company. Patterson's examination, which began as a standard regulatory review, quickly revealed discrepancies that suggested massive fraud. Court testimony indicates that Patterson discovered loan transactions totaling more than $100 million that could not be adequately documented or explained by National Heritage management. According to Patterson's testimony, National Heritage executives provided explanations for the questioned transactions that were internally contradictory and inconsistent with standard insurance industry practices. When pressed for additional documentation, company officials claimed that relevant records were stored at various off-site locations and would require time to retrieve. The pattern of evasion and misdirection convinced Patterson that National Heritage was facing serious financial problems, possibly involving criminal activity. His report to state insurance commissioners recommended an immediate comprehensive examination of the company's books and records. State regulators moved quickly once they understood the scope of the potential problem. In March 1994, the Florida Department of Financial Services placed National Heritage under administrative supervision, effectively freezing the company's operations while investigators determined the extent of any fraud. The administrative action triggered a cascade of events that would expose the full extent of Weiss's criminal enterprise. Federal authorities, alerted by state regulators, launched their own investigation under the supervision of the FBI's Financial Crimes Unit. FBI Special Agent Patricia Collins, who led the federal investigation, later testified that the National Heritage case presented unique challenges because of the sophisticated nature of the fraud. Unlike simpler embezzlement schemes, this case required investigators to trace money through multiple corporations, offshore accounts, and complex financial instruments. The investigation team included FBI financial analysts, IRS criminal investigators, and prosecutors from the U.S. Attorney's Office for the Middle District of Florida. Court documents reveal that investigators ultimately reviewed more than 50,000 pages of financial records and conducted hundreds of interviews with National Heritage employees, policyholders, and business associates of the accusee. To conspirators, One of the investigation's major breakthroughs came when federal agents executed search warrants at multiple locations connected to Weiss and his co-conspirators. These searches, conducted simultaneously in Florida, New York, and New Jersey, yielded thousands of documents that helped investigators understand how the fraud had been structured and executed. Agent Collins testified that among the seized materials were detailed financial records showing the movement of money from national heritage to various shell companies controlled by Weiss. These documents provided the evidence prosecutors needed to demonstrate that the insurance company had been systematically looted by its owners. The forensic accounting analysis required to untangle the national heritage fraud took more than 2 years to complete. Court records show that investigators ultimately identified more than $450 million in policyholder funds that had been diverted from their intended purpose. The complexity of the scheme became apparent as investigators traced money through a network of more than 30 companies, many of which existed only to facilitate the movement of stolen funds. Some money had been transferred to offshore accounts in jurisdictions with strict bank secrecy laws, making recovery difficult or impossible. In November 1998, federal prosecutors announced indictments against 5 individuals connected to the national heritage fraud. The charges included racketeering, wire fraud, money laundering, and interstate transportation of stolen property, charges that carried potential sentences of life imprisonment. Sholam Weiss was identified as the primary defendant, accused of masterminding the conspiracy and directing the theft of hundreds of millions in policyholder funds. His co-defendants included Keith Pound, described by prosecutors as a key financial facilitator, Jan Schnunz, Eiderman, who allegedly helped structure fraudulent loans, and Jan Starr, accused of assisting with money laundering operations. The investigation revealed that the national heritage fraud had been far more than a simple theft scheme. Prosecutors described it as a sophisticated criminal enterprise that had corrupted legitimate financial institutions, defrauded thousands of victims, and undermined public confidence in the insurance industry. As the case moved toward trial, federal investigators continued working to trace stolen assets and identify additional victims. The investigation ultimately revealed that the impact of the national heritage fraud extended far beyond the immediate financial losses, affecting the entire structure of insurance regulation in the United States. The federal trial of the national heritage conspirators began in Tampa, Florida, in October 1999, nearly 5 years after the insurance company's collapse. The proceedings would expose the full scope of one of the largest financial frauds in American history, while raising troubling questions about the ability of the criminal justice system to address sophisticated white-collar crime. United States District Judge Susan Bucklew presided over the trial, which prosecutors expected to last several months given the complexity of the financial evidence. The government's case would ultimately involve testimony from more than 100 witnesses and the presentation of thousands of documents tracing the movement of stolen money through multiple jurisdictions. Lead prosecutor Michael Rubenstein outlined the government's case in his opening statement, describing the national heritage fraud as a conspiracy that had systematically destroyed the financial security of 25,000 American families. Court transcripts record Rubenstein telling the jury that the evidence would show deliberate, calculated theft on a scale that defies imagination. The prosecution's case methodically documented how Weiss and his co-conspirators had gained control of national heritage through fraudulent means, then systematically extracted hundreds of millions of dollars in policyholder funds. Financial expert witnesses testified about complex money laundering schemes that had moved stolen money through networks of shell companies and offshore accounts. FBI agent Patricia Collins testified about the extensive investigation that had uncovered the fraud, describing how agents had traced more than $450 million in stolen funds through dozens of financial institutions. Her testimony included detailed charts and diagrams showing how money had flowed from national heritage to entities controlled by thieves. Defendants. Victim witnesses provided emotional testimony about the impact of the fraud on their families. Margaret Thompson, the Jacksonville mother whose children's college fund had been stolen, testified about the devastating discovery that her insurance policy was worthless. Her testimony reduced several jurors to tears, according to court observers. The defense strategy focused on portraying the national heritage collapse as a legitimate business failure rather than criminal fraud. Defense attorneys argued that Weiss and his associates had attempted to save the struggling insurance company through aggressive but legal financial strategies that ultimately proved unsuccessful. However, the defense case was severely undermined by a shocking development that occurred just weeks before the trial's conclusion. On October 23, 1999, Sholam Weiss failed to appear in court, having jumped bail and fled the country. Federal marshals discovered that Weiss had traveled to Austria, a country with limited extradition agreements with the United States. Court records reveal that Weiss's flight had been carefully planned, involving the liquidation of assets and the arrangement of transportation through intermediaries. His disappearance left his co-defendants to face the full weight of the government's case without their alleged leader present to testify or be cross-examined. The jury deliberated for 2 weeks before returning guilty verdicts against all remaining defendants. Keith Pound, Jan Schneiderman, and Jan Starr were convicted on multiple counts of racketeering, wire fraud, and money laundering. The jury also found Weiss guilty in absentia on all charges related to the conspiracy. Judge Bucklew's sentencing reflected the unprecedented nature of the fraud. In January 2000, she imposed sentences ranging from 10 to 25 years for the co-conspirators who were present. For Weiss, tried in absentia, she imposed a sentence of 835 years in federal prison, possibly the longest sentence for a white-collar crime in American history. The aftermath of the trial revealed the limited ability of the criminal justice system to provide restitution for fraud victims. Despite the convictions, court-appointed trustees were able to recover only a small fraction of the stolen money. Most of the $450 million taken from national heritage remained beyond the reach of law enforcement, hidden in offshore accounts or already spent by the conspirators. State insurance guarantee funds provided partial compensation to some policyholders, but coverage was limited, and many victims received only pennies on the dollar compared to their original policy values. The inadequacy of victim compensation highlighted significant gaps in the financial safety net designed to protect insurance consumers. Unclaimed assets. Weiss remained a fugitive for more than 2 years before being captured by Austrian authorities in 2002. His extradition to the United States required complex diplomatic negotiations, as Austrian law prohibited the transfer of individuals facing sentences exceeding 20 years. The extradition controversy ultimately required intervention by high-level diplomatic officials and took nearly a year to resolve. When Weiss was finally returned to American custody in 2003, he began serving what was effectively a life sentence for his role in the national heritage fraud. The national heritage case had profound implications for insurance regulation in the United States. State insurance commissioners implemented new oversight procedures designed to detect similar frauds before they could cause massive policyholder losses. Federal lawmakers considered legislation that would provide stronger protection for insurance consumers. However, regulatory experts noted that the sophisticated nature of the national heritage fraud demonstrated that determined criminals could still exploit weaknesses in the financial system. The case served as a warning that insurance fraud remained a significant threat to American consumers despite increased regulatory attention. In an unexpected postscript to the case, President Donald Trump commuted Weiss's sentence on January 19, 2021, his final full day in office. The clemency decision sparked controversy among fraud victims and law enforcement officials who argued that Weiss had shown no remorse for his crimes and had never cooperated with efforts to recover stolen assets. Today, more than 2 decades after national heritage's collapse, many fraud victims continue to feel the impact of their losses. The case remains a stark reminder of how white-collar crime can destroy lives as completely as any violent offense, and how the complexity of modern financial systems can be exploited by sophisticated criminals. The national heritage fraud fundamentally changed how investigators and prosecutors approach large-scale insurance fraud cases, but it also demonstrated the limitations of the criminal justice system in addressing crimes that span multiple jurisdictions and involve complex financial instruments. The national heritage life insurance fraud was not an isolated incident, but rather a harbinger of increasingly sophisticated financial crimes that continue to threaten American consumers today. In the decades since Sholam Weiss and his co-conspirators were convicted, insurance fraud has evolved into a multi-billion-dollar criminal enterprise that adapts constantly to new technologies and regulatory frameworks. According to the Federal Bureau of Investigation's most recent financial crime statistics, insurance fraud now costs American consumers more than $40 billion annually. This figure represents a dramatic increase from the estimated $20 billion in annual losses recorded during the 1990s, when the national heritage case first exposed the vulnerability of the insurance system to large-scale criminal exploitation. The Coalition Against Insurance Fraud, a national advocacy organization, reports that modern insurance fraud has become more sophisticated and harder to detect than the schemes employed by earlier generations of criminals. Contemporary fraudsters use advanced technology, complex corporate structures, and international money laundering networks that make traditional investigative techniques less effective. Recent cases demonstrate the continuing evolution of insurance fraud techniques. In 2019, federal prosecutors in New York announced charges against a network of individuals who had defrauded no-fault automobile insurance programs of more than $100 million through fake medical clinics and staged accidents. The scheme, which authorities described as one of the largest no-fault insurance frauds in New York history, involved many of the same techniques pioneered by the national heritage conspirators: shell companies to hide money movement, fraudulent documentation to justify illegitimate transactions, and complex corporate structures, designed to confuse regulators and investigators. State insurance regulators report that they are seeing increasing numbers of cases involving criminals who specifically target struggling insurance companies for takeover attempts. The national heritage model, purchasing a financially distressed insurer with fraudulent funds, then looting its assets, has been attempted repeatedly across multiple states. In 2018, California insurance commissioners prevented a similar scheme when they discovered that investors attempting to purchase a troubled life insurance company had provided false information about their financing sources. The attempted takeover bore striking similarities to the methods used by Weiss and his associates 3 decades earlier. Modern insurance fraud has been transformed by technological advances that were unavailable to criminals in the 1990s. Fraudsters now use sophisticated computer systems to create fake policy documentation, manipulate electronic payment systems, and target potential victims through online marketing campaigns. Cybersecurity experts report that criminal organizations are using artificial intelligence and data analytics to identify vulnerable insurance companies and individual policyholders who might be susceptible to fraud schemes. These technological capabilities allow modern fraudsters to operate at scales that far exceed what was possible during the national heritage era. Consumer protection agencies report that insurance fraud victims today face many of the same challenges experienced by national heritage policyholders. Despite improvements in regulatory oversight and victim compensation systems, individuals who lose money to insurance fraud often recover only a small percentage of their losses. The National Association of Insurance Commissioners has implemented new early warning systems designed to identify potential fraud schemes before they can cause massive consumer losses. However, insurance industry experts acknowledge that sophisticated criminals continue to find ways to exploit regulatory gaps and jurisdictional limitations. One of the most significant changes in insurance fraud since the national heritage case has been the increasingly international nature of these criminal enterprises. Modern fraudsters routinely use offshore banking systems, cryptocurrency transactions, and international corporate structures to hide stolen assets and evade law enforcement. The European Union's financial intelligence agencies report that American insurance fraud schemes now frequently involve the movement of stolen money through multiple countries within hours of theft. This international dimension makes investigation and prosecution far more complex than cases like national heritage, where most of the criminal activity occurred within the United States. Recent cases have involved criminals who purchase failing insurance companies in one country, then immediately transfer policyholder assets to accounts in jurisdictions with strict banking secrecy laws. By the time regulators discover the fraud, the stolen money has often been moved through several countries and converted into untraceable assets. Insurance regulators acknowledge that the international aspects of modern fraud present challenges that existing legal frames struggle to address. The national heritage investigation, complex as it was, involved primarily domestic financial institutions and could be resolved through traditional federal law enforcement channels. Today's insurance fraud cases often require cooperation among law enforcement agencies in multiple countries, each operating under different legal systems and investigative procedures. These complications can delay investigations for years and allow criminals to escape prosecution entirely. Research conducted by victim advocacy organizations suggests that modern insurance fraud victims experience trauma similar to what national heritage policyholders reported in the 1990s. The psychological impact of discovering that trusted financial institutions have betrayed that trust appears to be consistent across different types of fraud schemes. However, modern victims face additional challenges related to the complexity of contemporary fraud schemes. Many struggle to understand how they were victimized, making it difficult to seek appropriate help or participate effectively in legal proceedings against the perpetrators. The insurance industry has implemented numerous fraud prevention measures based on lessons learned from cases like national heritage. These include enhanced background checks for individuals seeking to purchase insurance companies, improved financial monitoring systems, and stronger coordination between state and federal regulators. Consumer advocacy groups have developed educational programs designed to help individuals recognize potential insurance fraud before they become victims. These programs emphasize the importance of researching insurance companies' financial stability and understanding the warning signs of fraudulent sales practices. Congressional response to high-profile insurance fraud cases has included legislation strengthening penalties for financial crimes and improving coordination among regulatory agencies. The Sarbanes-Oxley Act, passed in 2002, included provisions specifically designed to prevent the type of corporate fraud that characterized the national heritage case. State legislatures have also enacted reforms aimed at preventing insurance fraud, including mandatory reporting requirements for suspicious financial transactions and enhanced powers for insurance commissioners to investigate troubled companies. Despite these improvements, law enforcement officials acknowledge that sophisticated criminals continue to develop new methods for exploiting the insurance system. The national heritage case demonstrated that determined fraudsters could steal hundreds of millions of dollars before being detected, and similar vulnerabilities persist today. The story of National Heritage Life Insurance Company serves as a permanent reminder of the devastating impact that financial fraud can have on ordinary American families. 25,000 policyholders trusted their financial futures to a company that appeared legitimate but had been captured by criminals who viewed their life savings as an opportunity for theft. The case also demonstrates the limitations of regulatory systems designed to protect consumers from sophisticated financial crimes. Despite extensive oversight mechanisms, Sholam Weiss and his conspirators were able to operate their fraudulent scheme for years before being detected. Today, more than 2 decades after National Heritage's collapse, forensic accountants estimate that less than 10% of the stolen money has been recovered and returned to victims. Most of the $450 million taken by the conspirators remains hidden in offshore accounts or has been spent on assets that cannot be traced. The human cost of the fraud extends far beyond these financial figures. Thousands of families saw their dreams destroyed by criminals who exploited their trust in the American financial system. Children who should have attended college on insurance money instead entered the workforce immediately after high school. Retirees who expected comfortable golden years supported by annuity payments were forced to depend on relatives or return to work in their 70s. As we've seen throughout this investigation, insurance fraud continues to evolve and threaten American consumers. The sophisticated techniques pioneered by criminals like Sholam Weiss have been adopted and improved by new generations of fraudsters who understand that insurance companies hold vast sums of money that can be stolen if the right opportunities present themselves. The best defense against insurance fraud remains an informed and vigilant public. Before purchasing insurance policies, consumers should research companies' financial stability through state insurance, department websites, and independent rating agencies. Warning signs of potential fraud include unusually high returns promised on insurance investments, high-pressure sales tactics, and companies that discourage customers from researching their financial condition. If you suspect insurance fraud, report it immediately to your state insurance department and the National Association of Insurance Commissioners. Early detection of fraudulent schemes can prevent the type of massive losses experienced by national heritage policyholders. The national heritage case reminds us that the promise of financial security can be an illusion if we fail to verify that the institutions we trust are worthy of that trust. In an era of increasingly sophisticated financial crime, eternal vigilance truly is the price of protecting our families' financial futures. What happened to National Heritage Life Insurance Company was not just a crime, it was a betrayal of the fundamental promise that insurance companies make to their customers. Understanding this history helps us recognize similar threats that continue to exist today and empowers us to make the informed decisions necessary to protect ourselves and our families from becoming the next victims of insurance fraud. Thank you for watching this investigation into one of America's most devastating insurance fraud cases. If this story concerns you, make sure you're subscribed to our channel. We investigate these forgotten financial crimes that continue to threaten consumers today. Leave a comment below telling us what state you're watching from and whether you've ever questioned the stability of your insurance company. Your engagement helps us uncover more stories that the financial industry would prefer to keep buried. Next week, we'll investigate the collapse of Executive Life Insurance Company, a California-based insurer that failed in 1991 after executives invested policyholder funds in junk bonds that became worthless. That case affected more than 350,000 policyholders and revealed additional weaknesses in insurance regulation that criminals continue to exploit today. Until then, remember, in the world of financial crime, the most dangerous criminals are often the ones wearing business suits and promising to protect your family's future. Stay vigilant, stay informed, and never stop asking questions about the institutions you trust with your money.